go anywhere with you, 'cause you fill my mind, oh, you fill my mind. We could build a dream, start up something new, and the world is on your shoulders, and you feel like falling over. Just let me in your head so I can be there for you, there for you. The night is young, won't you sing for me? Won't you sing for me? Till we fall asleep. The night is.
Well, hello, everybody. Welcome to VC Masters Only on the Pod TV network. And today, of course, we're going to be looking at venture capital companies, and the latest in venture capital news. And with that, we're going to bring in the venture capitalist himself, none other than Dr. Salman Azar, the VC himself, who can probably give us some light on what's going on in the venture capital world, especially when the headlines is all about the Iranian war. There's got to be some things going on in the venture capital community. So I'll turn over to you, Dr. Azar. What do we have in terms of the latest and greatest news in the VC world?
Well, before we get to the sad and harrowing news of the world, I wanted to kind of like share with you that whenever you say venture capitalist, and this is not you, Nick, in particular, but anybody does, it kind of sounds like I'm a capitalist. This is not kind of like a capitalist thing to do. It is not kind of like a political statement or a financial statement, anything. So focus on the word venture, because that's what we are really about. So it's a very strange time, and it has been a strange time, for many years now, for any kind of investor, particularly venture investor. And the reason I say that is that it used to be in the good old days, when dinosaurs roamed the earth. Well, maybe a little bit later than that we could look at the fundamentals of the company, look at the fundamentals of the business, and say, okay, this is investable, this is not investable. And if it is investable, this is kind of like what the probabilistic outcome is of this company. This is the probability that we would get 100x return. In other words, we would put $1 and we would get $100 back. And this is the probability that we would lose all our money. And this is the probability we'll get 50x return, 10x return, et cetera, et cetera. And then that has become harder and harder and harder, because so many things are impacted by what is going on in the world. Now, if you look at the public markets, let's say you look at the Google stock or Amazon stock, you would look at it and say, okay, the Iran war started, this, particular stock dropped 10 points, or, 5% or 2% or 1%, or some may actually even increase. And you get that feedback. So venture capital investing or venture investing becomes harder because we don't get that instant feedback on things. And that is a good thing, and it is a bad thing. The reason it is a good thing is that sometimes that feedback feeds on itself, and some stock that was supposed to be only 0.5% down ends up being 5% down because you see it going down, and fear strikes and this and that, and people then start selling more and more, or on the flip side, you see it going up and you have this fear of missing out, etc., etc. So we have to in the venture industry, we have to rely mostly on the fundamentals with all these things happening, and that feedback loop that can exaggerate the impact is not there, which is a good thing. The bad thing is that we don't have much feedback at all. To give you kind of like an example, that we had a company that was going public in June, and we don't know when it is going public now anymore, because the war started. First actually there was like a big blip, a big and short blip of the AI impact. All these investors got worried about the impact of AI on things, and then the war started, and now companies, if I ask any of my portfolio companies, what are your plans to go public? Their thing is, I don't know. So, I mean, even the company that was planning on June, which is now 3 months away, is like, I need to wait until the war stops before I do anything. So that's kind of like, the summary, and we can kind of get started with that, and we can dig deeper into any of the aspects that you would like me to dig deeper in.
Well, I think one of the biggest aspects is when people look at companies, and something I want you to address is valuations. In other words, especially closely held corporations that have income, balance sheets, asset statements. When a publicly traded company is valued, you can go and collect the data, and you can see what the stock price is. You can see the price earnings ratio. You can see the 5-year trend. In other words, you get a lot more data. But the real problem is when you have a closely held company or a company that's pre-IPO or an IPO win, is how do the venture capitalist or the investors set the valuations? In other words, do you do multiple of earnings? Do you do multiple of revenue? Do you do a combination of both? Do you do a projection in the future? I think that valuing companies can be a fairly difficult, if not a precise science, it looks like. So what do you do when it comes to corporate valuations? We work with a lot of small companies, and getting valuations is really difficult.
Yeah. No, so you're absolutely right. What do we do? So the framework. So I can give you the framework, because there's like no one answer in terms of what do we do. Actually, let's first start. I can give you one answer in terms of what Google is worth right now, because I can just go on any website, any financial website. I can go on Finance Yahoo. I can go on like CNBC. And there would be a number there that says market cap. The market cap is the value of that company. And let's say that market cap says $3 trillion. That's the value. Now, if Google goes up 10% tomorrow, or comes down 10%, that market cap would immediately be recalculated with the stock price. So it's a very easy thing. It gets a little bit harder if you say, okay, where is Google's price target going to be in 1 year? But let's not go there. Let's just not add time to it. Let's just focus on right and now. So what we do is we use a framework called CCA. And actually, I shouldn't say we. That's what our firm does. And I mean, other firms may be doing something different. And CCA works kind of like this, that you take the company and you look at comparable companies. In fact, the CC in CCA stands for comparable companies. And the A, you can imagine what it stands for, but don't let your imagination run too wild, stands for analysis, comparable company analysis. Okay. So what we do is, let's say, we are trying to get a valuation on Questkey. We look at the companies that are similar to it, a firm, ABC, DEF, XYZ. We get about 5 for these companies, sometimes 10, sometimes 3, but let's say we get about 5 of these companies. And we look at these companies that are similar to it and compute a multiple of their revenue and their cash flow. And the cash flow may be negative, and their growth. So these are kind of the 3 things we look at definitely. And then sometimes, depending on the industry, we may look at other things. For example, we have a healthy lighting company called Chorus, and the most of its value is actually derived from its IP, intellectual property, because that can be monetized over a long time without even a company, making anything, because they can just get licensing deals for licensing their patents over to somebody else. So with all this, what's happening now is that we are taking all these different values, whether they are patents, whether they are sales or cash flow, and then we are computing the multiple for each one of these companies. We take a weighted average of this and then apply that to the company that we are analyzing. So
okay, it brings up another question. When you do your investing, do you look to obtain a minority interest or controlling interest, or does the person who is selling their interest, are they concerned about losing the controlling interest in the corporation?
Yeah. So, so being a minority, no, that has nothing to do with it, actually. I always take a minority interest because I'm a venture capitalist. And venture capitalists or VCs always are looking for a minority interest. Our formula is that we will take X%. Well, okay, actually, let's look at. So there are different stages we invest, but let's look at a very early stage. At very early stage, we are looking for like 15 to 20% of the company, and we want to take a minority interest, which is that 15 to 20%, and we believe that if we leave the majority with the founder and the initial team, they will be more incentivized to grow the company, and that they know how to grow the company better than we do because they are fighting this war in the trenches. And we are just sitting in our ivory towers or different color towers, red tower, whatever tower, and we're just watching this. Or, you can, these days, actually, it's probably a better analogy is that we are just watching it in the news or on YouTube, or we are looking at, Twitter or data miner. Data miner is actually a better thing for like these kind of global events, that how things are going. So the people in the trenches know better what's going on. And because we are heavily incentivized, they will do what is best for the company. The private equity model is slightly different. They want to get a majority stake. They usually want to get it 51%, set targets, have the right to hire, fire founders, et cetera, et cetera, et cetera. They don't trust that the human greed or human incentive principle. They feel that they need to it's more of a stick approach, whereas ours is a more of a carrot approach. We are looking to invest $1 and have the hope of getting multiple returns, and willing to risk losing our money as well. Whereas the private equity, they are saying, yeah, we want kind of like 2x, 3x return. I mean, if somebody like a private equity person gets 3x return on your original investment, most of their investors would wash their feet and drink the water that they wash the feet from. In our case, I mean, we are shooting for much higher than 3x, and we are willing to kind of give up a little bit. So, I mean, that's kind of like, I'm happy to kind of dig into it. I think I did a lot of a high level kind of thing, but whatever is unclear, happy to dig into it.
Okay, another important issue that comes up in corporations is corporations' debt. Private equity does tend to want to purchase corporations and load them up with debt, which of course can create a major windfall, but also can create a crash for the corporation. What do venture capitalists or investors look at a company if they have current debt, or do they encourage the corporation to borrow money?
Well, that's hard to come up with a general answer on that, because it does vary based on whatever the firm's criteria and objectives are. Generally, we believe that the cost of debt is less than the cost of equity, and we want to invest equity in the company, and then at times there will be debt that would come about. So to give you kind of an example, we have a company called Quisky that is a fintech company. It is like FICO, if you're familiar with the US company FICO, which basically gives credit rating for people. And we have invested all in equity, but there is a credit line that the company uses to basically finance like short-term kind of growth. For example, recently Amazon entered into a partnership with them that you can do buy now, pay later through Amazon, and that meant they need to have a credit line to invest in that growth, rather than go and get more equity, which would dilute everyone. So let's see if they sold 5% of the company, that means that everybody else, loses about 5%. They get diluted. We say that we get diluted. It's just like, for example, if you have 10 owners of a company and then an 11th owner comes in and they're all, let's say, for simplicity, equal owners, the original 10 owners get diluted. They own less of the company. So instead of like getting a new investor, we would rather that they borrow the money so that we don't get diluted, because cost of borrowing is less. But the thing is that we do not want to, basically put so much debt on the company that we risk collapsing that company under the debt, in terms of debt servicing and stuff, because the debt servicing usually means that you have to make monthly payments or quarterly payments of interest and sometimes principal, whereas when you're taking equity or when you're selling equity, you don't have to pay it back until the company basically goes public, where people can sell their shares and so on and so forth.
And when you're working with management, how do you get an alignment of management on your side? So when you're an investor, to make sure that the management is operating in the best interest of the company, do you pay them salaries, bonuses, stock options, or a combination of both? How do you work with getting management to, what I say, move in the right direction?
So venture people use mostly the carrot thing. We believe that if the management is incentivized to do well, they will do well. So let me kind of like share with you the way the most people can relate to it. If you are, let's say, a person in a company, an executive in a company, there are two ways that you are usually compensated that you know about. One is that you get a salary. The second is that you get a bonus. There's a third way that you really don't think about, which is like, if you don't do a good job, you get fired. So getting fired is kind of more of a negative kind of incentive. The salary is kind of like a fixed thing. And the bonus is really about you growing things and having an impact, and, the company sharing its profits or its growth with you. If you look at venture industry, we are mostly about the bonus portion. And that bonus portion in our case is the stocks that the employees own. So for example, actually I shouldn't mention this because I don't have the privacy clearance, but let's say, you have a friend that works for XYZ company, and the XYZ company goes public. Now they can sell their shares in the open market and at, let's say, whatever the current price is, at $40 a pop. And they acquired these shares at, let's say, 4 cents a pop. So you are basically, they have like this unbelievable kind of gain, even with a few shares. By the way, there are some restrictions on when you can sell it. Let's not get into that, but generally that is the bonus. And that bonus is really much higher than any salary or anything like that can do. And then the flip side of it is that if they do not do well and they do not go public, or they do not get acquired, they lose all that upside that they have. And typically startup employees get paid much less. They would, where somebody, an executive at a company like Google is making hundreds of thousands of dollars a year. This guy, that is working in a similar, role and doing, working probably harder than anybody at a public company, would be getting, let's say, 180,000 a year or 150,000 a year, and living like in San Jose, where that money can buy you kind of like, well, it can't buy you any real estate. It can buy you probably a cardboard box, but you're probably looking at renting a small apartment somewhere. And that means like you can't really have children right now because the children don't have any extra place to sleep. And no playgrounds, no nothing. And you're just living in this like small apartment, and you're paying like $3,000 a month, or $5,000 a month for it. So, yeah, it's a very different world.
Yeah, and it is a different world. And another important part of the world is patents and trade secrets. When you look at a company, are you looking at companies that have patents and trade secrets? Because otherwise, if you have a great idea, but everybody can replicate the great idea, then your idea isn't worth very much. So are you looking for companies that have patents or trade secrets in terms of investing?
Well, I'm glad you said patents and trade secrets, because a lot of people would know about patents and sometimes they're very proud of patents, but the trade secrets are just as an important way, or as common way to protect intellectual property. The general umbrella is intellectual property, sometimes abbreviated as IP. And intellectual property is what I can use and other people cannot use. Patents are a very defensive measure, and patents say that, hey, I know how to do this, or I have this little secret. I am going to tell you this secret, but you cannot use it. And what that does is that prevents anybody that knows or learns about that secret from using that secret. And if they use it, then I can sue them in patent court, and I can get some kind of a judgment, either a compensation or of some sort, or some future consideration, or sometimes I may even work out a business arrangement with them where they pay me royalty or something like that. So that's like the patent part. What is not usually common knowledge, and a lot of people don't think about, is trade secrets. So trade secrets are secrets that I keep, that I don't tell anybody, so that they cannot use it. Kind of like a very simple example of trade secrets is what Facebook does. So Facebook has all this functionality where you could post and do this and do that and so on. And you know that they are doing some kind of a data analysis so they can sell your information to somebody at some point in time to monetize you. Facebook doesn't keep what it's doing secret. You can post, exactly what people post, or how those people can follow up in comments. My developers can easily take that information and make a replica of Facebook and have exactly the same functionality without too much money these days, because there's so much AI help that you can use in coding. But what prevents us from competing with Facebook is what Facebook does with that information after it's done. That is the trade secret. Even though a lot of what Facebook is doing is public knowledge, what is happening behind the scenes is not, and that is trade secret, and that is a value only Facebook is extracting. And you and I can sit here and try to second guess what Facebook is doing with it, but we don't have that information because that is their trade secret. Patents, trade secrets, and any other intellectual property you can think of, or any other mechanism of protecting intellectual property you can think of, adds value to the company because it's something the company can do and other cannot do. And that's basically a value that we as investors need to identify and accurately assess how much that is.
Yeah, and identifying companies is extremely important. And there was one company that was sitting on the 10 years ago, you wouldn't even heard about it. It's called NVIDIA. And today it is like, it's huge. It took the huge position away from Intel and other computer chip makers. Are you able to look at a company and see which company perhaps would be the next NVIDIA?
So I'm one of few people. I shouldn't say few people. I'm one of the people that knew about NVIDIA, many years ago, 15 years ago. And the way I knew it, interestingly, is because I had friends that were working there. And I knew that this company is going to go somewhere. And to be honest, I couldn't imagine where it is now. But the reason I could is that the hiring process and the kind of people they hired was really, really, it was really great. It was really excellent. And everybody that worked there was a rock star. Anybody that got in to work for NVIDIA was a rock star. the standards have been lowered slightly, but still, I think, I can go out on a limb and say that NVIDIA is one of the hardest publicly known company to get employment offer from. But that leads to kind of an interesting point, right? How do we figure out what the next NVIDIA is? And it's I'll take half an NVIDIA. I would even take like a tenth of NVIDIA right now if I had one. So how do I do that? So it's really, really hard. I mean, I to be honest, like I will have to take about 100 shots to find one NVIDIA or anything close to it. And that's kind of how our process works. So I've invested in over 300 companies now. And, even my brother thinks that's crazy. He says that that's like this professional ADHD of investing or something like that, where it sounds like you don't know what you're doing. It sounds like you just get up in the morning and you start investing in companies, but it's not quite that. For investing, finding the next NVIDIA, we use more of a probabilistic calculation, and we look at many things. And every venture investor has their own criteria. I have 4 things I look for. I look at the problem space they're in. The problem space is NVIDIA makes chips. Google used to be a search company, et cetera, et cetera. Amazon is an online retail company. That's the problem space. And that problem space tells you how far this company can go. If the company is dealing with a large problem space, it is like you go to a camp field and you have a lot of choices where to pitch your tent. And if it rains and parts get wet, you can easily move the tent. And so having the large problem space is my number 1 criteria, because that tells me that I have the growth opportunity. And if I don't have the growth opportunity, I don't have the next NVIDIA. The second is the people, and a lot of people think that a lot of investors think that people should be your number 1, and at least everybody says that, even if they don't believe that, because they want to be nice to people. But people are really number 2, and the reason is that people cannot be chained to a desk, and you can't keep them for the rest of their life. They can move. They don't like you. They can go elsewhere. The third is the actual problem itself. What problem are they solving? And the fourth is the push or the solution. And if you notice, I had the problem space, people, problem, and then push, because I wanted to make it a 4P thing. I also have an appointment at Duke, as you mentioned, and that is specifically in the business school. And in the business school, actually I shouldn't say business school, but in the business world, whenever we want to coin an idea, we like to either make it some kind of an acronym or make it like 4 Ps or 4 Cs or something like that, so that we sound like we are really, really, really smart. So to pick the next NVIDIA, these are the 4 things to look at: the problem space, the people, the problem, and the quotient. And then it is from there on, it's really a probabilistic game. We would quantify this as best we can, but there's just so much unpredictability in these things.
And the final question deals with this issue: Silicon Valley versus the Research Triangle Park. Now, when I moved to Durham, there was this big thing in the South, the Research Triangle Park. But when I worked in Silicon Valley, I noticed they had some very interesting funds, like the Anderson Horowitz Fund that had $42 billion in assets under management. But I didn't see that in the Research Triangle Park. It seems to me that all the money is in San Francisco, but is that going to continue, or because of the tax policies, are people going to leave San Francisco and move elsewhere, like to Salt Lake, which we've seen, to Nevada, and perhaps even to the new place in town, which they haven't discovered, which is the Research Triangle Park? Are we going to see a migration away from the Bay Area because it's just way too expensive to do a startup or have a company be successful in that particular area?
Well, there's a long answer which we can cover later, but I don't see the New York Yankees moving out of New York, because New York is very costly, and setting up a little league team in Durham, North Carolina. And I love Durham, by the way, but it's not happening. And same thing with Silicon Valley versus Research Triangle. It is not happening anytime soon. there would be a little bit of leveling. I think there are going to be people like me and other people that are moving to Research Triangle. They're moving to Salt Lake City, et cetera, and the economics and the taxes was part of the consideration for me, and part of the consideration for a number of other people. If I loved skiing, I would have gone to Salt Lake City. But I don't like freezing in snow for half a year, so I'm here in Durham, North Carolina. But that's a conversation for another time, another place, because we are running out of time. So I'll tell you.
We are running out of time, but we want to thank Dr. Salman Azar, who heads up the Azimuth Fund. We have more questions for him we'll have to deal with later, but we want to thank our audience in the United States and around the world. And we'll see you next time on VC Masters on the Pod TV network. Take care.
I go anywhere with you, 'cause you fill my mind, oh, you fill my mind. We could build a dream, start up something new, and the world is on your shoulders, and you feel like falling over. Just let me in your head so I can be there for you.